A multi-asset credit strategy is a diversified strategy that seeks attractive global credit risk premia in different credit sectors as well as different credit asset classes. The potential benefits of an approach like this, say over a single asset class, is that you can reduce your concentration risk by investing across many different global sectors. Strengths to a multi-asset credit approach can include built-in portfolio diversification, the ability to tactically identify relative value, as well as a more holistic approach to risk management in a client's credit allocation. Many fixed income strategies are heavily reliant on both credit and sovereign exposure, which carry heavy interest rate risk with them. A multi-asset credit approach is one that balances both your credit risk and interest rate risk. The combination of those two together have historically led to more stable and stronger returns over a full market cycle. Additionally, the strategy offers global diversification, which may lead to a stronger return and income potential for many fixed income investors. We have now entered the longest expansionary period since World War II. Many global central banks are looking to prolong this phase of the cycle through their extensive and accommodative monetary policies. These policies have produced roughly 16 trillion of global negative yielding debt. Many fixed income markets are trading at or even through fair value based on this phase of the credit cycle. We believe that volatility is likely to remain high or at even more elevated levels in months to come. Therefore, the ability to be nimble and tactical with your asset allocation will lead to better downside protection. We are focused on moving up in quality, identifying companies that will likely generate free cash flow even if the economy worsens from here. We believe global central bank accommodation is a primary driver to the positive momentum we've seen in global fixed income markets. However, if trade tensions continue to escalate, we would expect global growth to slow, and there will be very limited capacity for central banks to prolong this current stage of the credit cycle. This dynamic would lead us to continue to move up in quality in our fixed income exposures, reducing our low quality high yield and our bank loans, as we feel recovery values in both asset classes are likely to worsen in an upcoming downturn versus previous cycles. With the overall level of global negative yielding debt supporting risk assets, we believe risk premia still remains attractive in parts of Latin America as well as the Middle East. In our view, pockets of the US still remain attractive, like telecommunications, technology, as well as the consumer. Areas that we are steering away from currently due to rising trade tensions and slowing growth are cyclicals. However, if global central banks are able to successfully extend this phase of the credit cycle, we could see a bid in cyclicals into year-end and into the beginning of 2020. A successful trade deal would likely be supportive of floating rate assets, as many investors have priced in extreme accommodation from global central banks, which will unlikely be necessary. Over the long term, we should be mindful of the next phase of the credit cycle. In downturns, yield curves tend to steepen, making short duration credit and sovereign exposures look more attractive.